Three things have changed since the US regional banking crisis in March. The first thing that has changed is that market expect lower central bank interest rates. As you can see from the drop in this chart from the beginning of March to the current level, a relatively sharp drop. There are two factors at play to explain it. The first one is there is a small but higher than previously thought risk of a financial crisis spreading from the US to banking sectors in other countries. The second one is that there is a greater likelihood of a credit crunch, especially in the US. That credit crunch would lower growth and therefore lower inflation, and therefore lower the need for higher interest rates. The second thing that's changed is that European systemic risk indicators have increased, but they have remained in check by and large. As you can see on the second chart, Europe has remained at the periphery of the banking crisis in the US and in Switzerland. And this means that these systemic risk indicators have remained below the peak that they've reached in 2022. So there is no widespread sign of a panic here in European markets, is the conclusion. The third thing that's changed is that European risk indicators that aren't related to the banking sectors have barely bulged, and in the medium term should reflect a more upbeat tone for financial markets. The first one is sovereign spreads. As you can see on this chart, they have barely widened, and the second indicator is swap spreads, which did widen, but we think this should prove a temporary phenomenon, and the swap spreads should retighten quickly. So in conclusions, European markets are largely relaxed, at least so far, about the risk of contagion from the US, and they now see the peak in this cycle for central bank interest rates.